talk to us about the correlation aspects. Kind of how do you, when you look for an investment like this, kind of how do you think about correlation and kind of what correlations do you look for?
Yeah, no, it's a good question. We spent a lot of time thinking about correlations. And even as a starting point, I think a lot of the science and everything we learn, like in college or CFA class, et cetera, I think it's very limited when it comes to correlations because what correlation data looks at is all backward looking data, whether markets are in an uptrend or a downtrend. And typically, when you think about when you need low correlations the most, it's in choppy markets or difficult markets. In other words, in up markets, which are call it 70 or 80% of the time, who really cares about correlation data, right? I mean, when things are going up, most everything goes up and your portfolio is going to be fine. You don't really need diversification in those times. Yeah. It's really in down times. You think about 2022 when the market hit a rough patch, or really nasty environments like 2000 or 2001 or 2008, where in essence correlations go to 1. That's when correlations matter. So you can almost throw out like 90% of the data. Who cares if you have 20 stocks in your portfolio and they behave differently when the stock market's going up? Because that blended portfolio will kind of do fine no matter which basket of stocks you have. The important point is in the downturn, in a time like 2008, guess what happens? They all go down together and you do not have a diversified portfolio. So that's as a starting point. We think when people look at correlation data, they're looking at the wrong data. You really should think about what happens on the downside. Mm-hmm. The second thing that I'd mention is when we think about correlation, we're actually counterintuitively seeking out risk. So what I mean by that is when we're building a portfolio, it's not avoiding risk. To make money in any investment, you got to take on risk, right? That's just kind of investing 101. But what we're looking for is individual investments that have different risk factors associated with it. So again, as I mentioned, most investments have simply they want to grow. Growth of the economy is one of the risk factors. Interest rates is another risk factor. Inflation. So what we're looking for when we're looking for lack of or lower correlation are investments that will march to the beat of a different drummer and have different risk factors associated with it. So going back to that healthcare example, again, it's not that there's not risk in an individual investment like I mentioned, but as you can imagine, that risk is much removed or much different than just plain vanilla stock market risk, or is the Fed going to raise interest rates by 25 basis points or not? I mean, that just doesn't matter with an investment like that. So we're looking for things that are just, again, going to be exposed to different risk factors than what traditional investments are exposed to.